You've got money in retirement accounts and you're looking at spending some of that money. You need to know how that's going to work. So how much tax would you pay on 401k withdrawals, and what are the types of taxes you need to be aware of? That's what we'll go through in the next couple of minutes. And this also applies to other types of retirement accounts like an IRA, 403b, the TSP, 457s. Those each might have their own features that are a little bit different, but for the most part, these concepts are the same. We'll start with the question of how much tax you pay. So any withdrawals from pre-tax retirement accounts are treated as ordinary income. That's the same type of income you get from working at a job. So it's effectively like earning more income from work. But withdrawing money from a retirement account is a little bit different, and we have at least 3 things we want you to be aware of. One is income taxes, one is penalty taxes, and the other is tax withholding, among other things. We're going to go over all of that and more. When it comes to income tax, you may owe federal and state income tax when using money from those pre-tax retirement accounts. And even if you have after-tax money in your accounts, withdrawing the earnings from those accounts can also cause taxation. So that could be the earnings on your Roth 401k balance, for example, or any after-tax balances that have earnings. Then, if you are under the age of 59 and a half, for most people, there are some exceptions. If you're under 59 and a half, you could owe additional penalty taxes. That's typically 10% of the amount you withdraw. So if you withdraw $10,000 early, a 10% penalty would be $1,000 on top of any income tax. And then there is withholding, and withholding isn't necessarily a tax, it's more of an advance or a deposit on your tax bill for the year. So your 401k may be required to withhold 20% of the amount you withdraw if you take a cash distribution, and they send that to the IRS. Depending on everything else that's happening on your tax return, you might end up owing more or getting a refund based on that tax withholding. And all of that said, you might not end up owing any taxes on a distribution from a retirement account. So there could be certain things happening on your return, or it's the nature of the money you withdrew. In some cases, you just won't owe anything. We'll go through the different puzzle pieces here so you can understand how it works, and with that information and some of the other videos I have, you will have a better idea of what to expect and maybe what you can do about it. But we'll start with the end, or the big picture, which is how much tax you might actually owe. So if we start out assuming somebody earns, let's say, $85,000 per year, they don't take any distributions from an IRA. This is just the baseline. Their income would be $85,000. They are single, so they get the standard deduction. So their taxable income is about $71,000, and they owe about $11,000 in taxes. But let's say that they take a withdrawal from a 401k or an IRA, for that matter, of $25,000. In this case, the entire $25,000 is going to be taxable, so that brings their income up to $110,000. Again, it's kind of like earning that income from a job. Once again, they have the standard deduction, which brings the actual income for taxable income down to $96,000. The tax is $16,000, but that's not all. There is also, in this case, because they are under the age of 59 and a half, there's a 10% penalty tax of $2,500. So the total tax due would be about $19,000. And if we go back to the baseline without a withdrawal, the total tax that was going to be due is about $11,000. So it's an $8,000 difference to pull out about $25,000. Next, let's say they're going to take a much bigger distribution. Maybe they want to pay off the mortgage, for example, and they have $150,000 in a retirement account. So they say, let's add that to the income. You can see that this gets them into quite a high income. And again, we are assuming a single person. It would be a bit different with a married filing jointly couple, but their taxable income will be $221,000. We've got the total tax due of about $49,000 or so, but there's also this $15,000 early withdrawal penalty, again, 10% of $150,000, bringing the total up to $64,000. So getting that big chunk of money out of a pre-tax retirement account can get quite expensive. That's not to say don't do it, but there might be some decent ways to reduce the amount of taxes you pay. Maybe you're just paying extra on that loan year by year instead of taking it out in one big chunk. Maybe you're going to pull some out in December of one year and January of the next year, for example, so that it all doesn't happen in one tax year. There just might be a variety of options to choose from. By the way, this can also affect you if you are on Social Security. It could cause more of your income to be included in your taxable income. So in this example, the person is getting $28,000 per year of Social Security. They're also withdrawing $18,000 just because they need that extra money for spending. So $3,900 of their Social Security is included in their taxable income. But if they take another lump sum, let's say $25,000 in this case, then $23,000 of their Social Security, of that $28,000, would be included in their taxable income, which can significantly increase the amount of tax they have to pay. So in this case, we've got $6,700 due if they took that $25,000 distribution, again, $6,700, and we're going to compare that to without the $25,000 distribution. It's only $710. So it's important to keep track of how this can affect your taxes. Now let's get into some more nuts and bolts on how all of this works. It's important to start out by understanding if what you're going to do is even a taxable event. So if you just move money from one retirement account to another retirement account as a direct rollover, that's typically not a taxable event. So if you take money from your 401k, roll it directly to an IRA with a check made payable to your IRA, you generally would not include that in your taxable income. But if you take a distribution, and that is where the money comes out of a retirement account and does not go right back into another one, that money might go into your bank account and you spend it. That is generally a taxable event. It's going to trigger the income tax potentially, plus maybe those tax penalties. Once again, the income tax is due when you withdraw pre-tax funds which have never been taxed from a retirement account. So some examples of that would include money you contribute out of your pay on a pre-tax basis. So you're putting in those pre-tax contributions to lower your taxable income. Another example is any funds that your employer deposits into your account pre-tax. Historically, those have pretty much all been pre-tax, but in the future there may be some Roth type money. These might be profit-sharing contributions or matching contributions, for example. There's also any growth inside of those pre-tax accounts. That is also going to get taxed when it comes back out. And then any earnings on after-tax accounts can also potentially be taxable. That's not the case if you can do a qualified distribution from a Roth account, but in a after-tax account, the earnings would be taxable. Those income sources are again treated as ordinary income, so you pay tax at whatever tax rate you're in when you withdraw the money. And you don't necessarily know what that will be if that's going to happen out in the future. But if we're talking in the immediate future, you can do some estimates and figure out what tax bracket you might be in. And don't ignore those state income taxes. If your state taxes income, it's important to consider that as well. The tax rate is typically quite a bit lower than the federal tax rates. Your federal income tax bracket depends on your income. So the higher your income, the higher the tax bracket you're in. And that income includes income from all sources. That might be a job you're working at. That might be dividends or interest that you receive. It might be these withdrawals from retirement accounts. People often assume that all of their income is taxed at their highest tax bracket or their marginal tax rate, but that's not the case. You generally pay tax at several different tax rates. So for example, in 2023, if you're a single filer, your first $11,000 of income is taxed at the lowest rate of 10%. The next $33,000, $375, is taxed at the next rate of 12%, and it continues from there. So quick example, let's say your income is $85,000. That puts you in the 22% tax bracket. You take a distribution from your 401k, a cash distribution, and you're 60 years old. How much tax do you pay? Well, you're above age 59 and a half, so you don't have to worry about that early withdrawal penalty. So a $15,000 distribution would add about $3,300 to your tax liability for the year. That is 15,000 times 22%. But things can get really interesting as the amounts grow. So if you earn that same 85,000 and you withdrew a much bigger amount, let's say 125,000, 150,000 as we looked at, you could put yourself into the 32% tax bracket for 2023. Once again, not all of that income is taxed at that highest bracket, but for the portion that is, you only get to keep $680 of every $1,000 you withdraw because, again, 32% goes away to taxes. The good news is that there may be some strategies you can use to reduce or avoid the taxes, so keep an eye out for other videos on that topic. Now, your tax bracket and the income tax aren't the only things to consider. There are other complications that happen when you take a big distribution. So let's talk about why that matters. But first, I am Justin Pritchard, and I help people plan for retirement and invest for the future. I'm going to have some resources in the description below that touch on this topic, give you a little bit more information on these taxes on withdrawals, as well as some general retirement planning information. I think you will find all of that very helpful. I encourage you to check that out. It's also important to remember it's just a short video here. We're not covering everything, so you really do need to do more research and triple check everything before you make any decisions. So getting into why this matters. There are at least three things to think about. One, as we looked at, a higher income can make more of your Social Security included in your taxable income. Another issue is that income above certain levels can require you to pay higher premiums for Medicare or marketplace health insurance. And in general, the higher your income, the less likely you are to qualify for various tax credits and deductions and assistance programs, that sort of thing. So it's important to monitor your income and avoid getting it too high. Now let's talk about withholding. So when you take money out of a retirement account, there are two things to be aware of. One is how much money you're actually going to owe the IRS. The other is the amount of withholding that happens when you take a distribution. The amount you actually owe the IRS depends on your income and deductions and everything else going on your tax return. And you can't know what that amount is until you complete your tax return, which doesn't happen until after year end. And to some degree, your distribution will likely increase the amount you owe. But there's also the question of withholding. So tax withholding is money that goes to the IRS as an advance payment or a deposit on your tax liability for the year. And that can happen at the time of your distribution, but it's probably not the exact amount that you actually owe. If you end up paying too much through withholding, then you might get a refund of that money, or it might offset some of the tax you would owe for other income sources. But on the other hand, if you don't withhold enough, you're generally going to owe more taxes. So when you file your taxes, you will find out that you didn't withhold and you owe the IRS money. And you could even owe underpayment penalties if you don't withhold enough. Whenever you take a cash withdrawal from a 401k, the plan is required to withhold 20% of the gross amount. That's called 20% mandatory tax withholding. So if your distribution is $10,000, the 20% amount would be $2,000, and you would end up getting $8,000. For most people, that mandatory tax withholding is a surprise. They want all of the money available quickly, and they don't realize that they can only access 80% of the funds in their 401k. But there are two instances, at least, when you can avoid mandatory withholding. One is a hardship distribution because it's not eligible for rollover. There is no mandatory tax withholding, but the distribution is still likely taxable, so you would owe income taxes. Direct rollovers to another retirement account are also not subject to the 20% withholding, and in general, they shouldn't create a tax liability anyway. If you wanted to spend all of the money from your 401k and you have a little bit of time, one option to avoid the mandatory tax withholding is to roll the money over to an IRA first. Then when you take distributions from the IRA, you can choose your tax withholding amount, which might be zero, but again, you would still owe taxes and you might end up getting underpayment penalties. Let's talk briefly again about the early withdrawal penalty. Again, that's under age 59 and a half for most people. It's an extra 10% that goes on top of any income tax due. But there might be some ways to avoid that tax penalty. The IRS has several exceptions that allow you to skip the penalty, so you definitely want to research that. And it's also important to know that if you leave your job at age 55 or later, then you can generally withdraw from that job's 401k or 403b without an early withdrawal penalty. But you can only withdraw from that job that you just left. So not from, let's say, a job you left under the age of 55. It has to be one that you left after 55. Governmental 457 plans can also allow you to access the money without an early withdrawal penalty. So that's important to think about if you leave one of those jobs before age 59 and a half. A lot of people ask about other ages as well and how that might affect things, but 59 and a half really is the biggie. It can go younger than that for some public safety workers, but age 65 doesn't necessarily change things. There might be some features in your state that help to ease the burden, but for the most part, we're talking before 59 and a half or after. If you do want some other ideas, keep an eye out for my next video, which is about how to reduce or avoid any taxes on those withdrawals. So I hope you found this helpful. If you did, please leave a quick thumbs up. Thank you and take care.